Welcome back to episode 37 of the
Lone Star Capital Podcast.
So I'm going to have to butcher that a couple of times to retrain myself to say it correctly, but we are now the Lone Star Capital Podcast in beautiful Sedona here today. Of course, Craig McGrother, the Director of Business Development, alongside the one, the only, Robert Beardsley III, a founder and principal of Lone Star Capital. How are you today?
I'm good. I'm feeling energized now that we've changed the podcast name. We were held back. We were in shackles in the previous paradigm of the Capital Spotlight.
And I think we owe Brian Spear, I think we shouted him out before, but we're going to give him another shout out here as he was speaking on the panel you were on at Raise Fest and got very specific to what he is, what his shows. It was basically like secrets or something to the tune of.
It was really funny. He was on
very,
stage.
very niche and discreet what it was.
Well, he was just being very blunt and his humor was kind of on the nose. He was like, yeah, so we invest in mobile homes. So we started the Mobile Home Investing Podcast. We're not looking to trick anybody.
Yeah, there's no secrets here. So it'll just be easier to find. And it's probably just more stuff where if you type in Lone Star Capital, it'll likely help for the Google algorithms, which is probably an unseen benefit to this, but the structure and change is great. But as always, we actually, last episode, mentioned this late, but we are, of course, still in Sedona. Just a quick little Sedona recap. It's been really incredible. The energy, the conversations we're having are awesome. We ate at Miraposa yesterday and Pizza Lisa, which were great. We did the Devil's Bridge hike. We played a lot of pickleball. My legs are beaten. I'm eating like a slob, but seemingly the movement is so great that I'm waking up looking lean. So we love that.
Yeah, I'm really enjoying this type of travel. And if you want to call it a vacation, sure, I'll call it a vacation. But getting a group of guys together in a house like this where there's something for everyone, we're just sitting around the living room talking and chatting and brainstorming, collaborating. This is really inspiring me and making, I think, all of us pretty excited about this. And I think the plan moving forward is basically to set up one of these trips quarterly and just invite people who we really respect and are high level and think that can be beneficial to the growth of the group. And for the individuals of the group. So that's something that...
This is not a solicitation saying please reach out to us. Don't. But definitely, I mean, I don't know if I would want it to be much bigger than 6 people. We had 5. So, kind of keep the nucleus of that would be my envisionment to make it most optimal.
Mm-hmm.
But, travel, whatever you want to call it like this, is really beneficial. I feel like I have just different directions I want to take, ideas and, personal and obviously Lone Star. So just having us here and thinking about, new concepts and fleshing things out with one another has been really beneficial. And it's just also the jokes and the banter has been second to none, as I'm sure all of you listening can appreciate and imagine. Nothing better than, letting it fly and shooting the breeze with your buddies.
Yep,
so
totally.
That's truly the most fun thing that the world has to offer, and the greatest things really are free, and having great friends, although maybe not cheap, but having great friends and conversations is in fact free, so long as you work at it.
Yeah, getting around different people, getting around different locations definitely rewires your brain, gets you thinking differently, which is really, really critical. And also, I'll use my trademarked phrase, which is travel is about people, not places. Right?
Mm-hmm.
I'm relatively indifferent as to where we take this show. It's just more important that we actually get the right people around so that we're able to really enjoy ourselves to the max and grow the most from leveling each other up and motivating each other, pushing each other. We're all very competitive guys, so we're getting competitive on pickleball, Connect 4, which is pretty silly.
You name it, there's competition. Yeah.
Yeah. So that's all really good.
And speaking of well, I guess we'll just get into housekeeping real quick, and we'll go to the meat and potatoes of the show. So, quick housekeeping. First things first, we are having our Houston meetup on March 12th. So, if you are an LP of ours or just an LP in other syndications looking to learn more about Lone Star Capital and how you can get involved as an investor, if you have a 1031 exchange coming up and looking to be an LP, or if you raise money and someone has a 1031 exchange coming up and in the Houston area, if you're a fund manager, if you're a co-GP capital raiser, if you're a joint equity venture group, please reach out to myself and we will give you the details on our event at March 12th if you're a good fit. On top of that, we will also be having our New York City office mixer on April 4th. So once more, if you hit those buckets and qualify for what I just mentioned, please reach out to myself and we can get you the information on that should you be a good fit and it's mutually beneficial. And then of course, following April 4th, we have the Best Ever Conference on the 11th and 12th, or 10th and 11th, I believe, actually.
Yep.
10th and 11th, Rob and myself, of course, will be holding court, meeting with as many people as possible in our Rolodex. Of course, we're going to be doing our typical in-fashion, greedy, Lone Star style dinners. So if you also meet the qualifications, as I just alluded to, LP, capital raiser, fund manager, joint venture equity group, please email me. You know the email, but once more, it's Craig, CRAIG, @lscre.com. So once more, just to recap that, we've got the Houston Mixer on March 12th. We have the Office Mixer in New York City on April 4th. And then, of course, the Best Ever Conference. Did I miss anything, or was that pretty smooth?
I think that's good for now. I think we can just simplify it rather than delineating every single type of capital partner out there. We could just say investors and fund managers. They know who they are. Reach out to us if you're interested in working with us.
Absolutely. Awesome. Well, one really interesting conversation that we also had that we weren't able to unpack on last show because we want to keep things tight, we didn't want to ramble for too long, was the idea and premise that pricing bottom isn't necessarily peak and cap rates. So that's a very potentially counterintuitive thought there, right? So can you please unpack that? And if I didn't phrase that correctly, if you don't mind, if you want to, if it's appropriate to rephrase kind of what I'm framing here just to set the picture perfectly.
Yeah, well, people are well aware of the most important formula in commercial real estate, which is the formula that we talked about on last week's show, which we actually recorded yesterday. So we're recording 2 shows. We're not just here in Sedona for weeks on end.
No, we got to make it a write-off.
Yeah, exactly. So that formula is, of course, the cap rate formula, which is cap rate equals NOI divided by value. And then you can shift those things around. You could say value equals NOI divided by cap rate, and so on and so forth. Now, when people get familiar with this, they, not necessarily incorrectly, they deduce the inverse relationship between cap rate and price, right? We all kind of learn this as we learn commercial real estate. We learn that, okay, the lower the cap rate, the higher the price. And that is true, right? That's just a mathematical fact. The higher the cap rate, the lower the price. That's why when we sell a property, we want to sell for the lowest cap rate. And when we buy a property, we want to buy at the highest cap rate.
Millions of dollars are created through cap rate compression if you can achieve it.
Absolutely. And also, if you can buy a property and add value to it, thus raising its income, you don't necessarily change the cap rate that it's valued at, but you change your cap rate that you own the deal at, right? And that goes into your operating cap rate or your stabilized cap rate, or also stabilized yield on cost. There's a lot of different ways to,
which is arguably the most important metric that sophisticated people actually ask for,
yes.
Which is, of course, stabilized untreaded yield on cost is the correct term?
That's correct,
yeah.
Yes. Yes, absolutely. With all that being said, there's, of course, nuance. And what we're experiencing, or what I think we're experiencing, in my opinion, as we're recording this in February 2024, I think we're experiencing peak cap rates. And what I mean by that is I think we're seeing the cyclical high in cap rates right now. Cap rates right now, depending on where you are and depending what asset class, but sticking to our Texas multifamily niche, cap rates are around 6%. Obviously, it can get
handicaps per market.
Yeah, it can get lower for nicer quality assets, higher for et cetera, right? We all know the understanding of risk pricing, right?
Well, one would hope.
One would hope.
Yeah.
Yeah, exactly.
Yeah, although we get capital partners who can't seem to see the nuances of a risk-adjusted return metric where, you should get paid differently on a risk perspective on a 60 deals as you should on a teens deal.
That's,
yeah.
Yep, totally understand the struggle.
But I'm sure everyone listening to this already knows that.
Everyone listening to this show is very sophisticated, so we don't have that problem.
Correct.
So the nuance comes in with the idea that we're experiencing, in my opinion, peak cap rates right now. So then people would say, oh, does that mean right now is the bottom? Right? And the bottom, I think people may infer as lowest prices, right? The bottom of pricing, and then prices go up from the bottom, right? Well, we can experience peak cap rates today, but then cap rates can hold steady, but we can still see price declines later this year, which I think is potential.
But cap rates could theoretically go down, although pricing could go down. Is that correct?
It could do that as well. That's going to mean that NOI has to really drop a lot. But let's say cap rates just stay steady at around the 6% range, and then NOI drops. Just by using the simple equation to calculate value, you would have now a lower NOI divided by or capped at the same cap rate, and that's going to result in a lower value. So even though I think cap rates are somewhere around their peak, I think value may still go down perhaps because NOIs may continue to soften, as we're seeing in certain pockets of the country where there's more supply and there's concessions. And if we do have a soft or hard landing, either way it's a recession, and there's going to be job losses, which may result in lower occupancies, lower rents, lower collections. And with all that, that's lower NOI, which just means lower valuations. So it's a very tricky game. Obviously, timing the bottom is a fool's errand, but I think it's interesting to understand the dynamic between peak cap rates, the bottom of pricing, and then, of course, our favorite, the spread between cap rates and interest rates. We've seen these peak cap rates for a while now, but all along, cap rates have been expanding for the last year and a half. Interest rates have been going up, they've been going down. It's just been such a volatile market, and depending on when you locked in your rate, assuming you're pursuing fixed rate financing, you may have ended up with a super attractive spread between your going in cap and perhaps your stabilized cap and your cost of debt.
Known as positive leverage,
Yes.
which has been in 2023 the code word all throughout, which is not easy to achieve when debt is going up. And of course, it's always a lagging indicator on pricing and cap rates. It's usually 6 months to flush out. So with that said, one can maybe potentially infer that maybe between now and potentially the new year might be the best timing of cap rates being at the highest, because trades, take a while for it to kind of fully unpack and go down. It could be a situation between now and the end of the year, rates kind of trickle down and cap rates kind of come up and then slightly start ticking down, but there could be a nice spread right here, right?
I really hope so, and I don't think we're going to see that spread improve via further cap rate expansion. I think we're going to see that spread improve via the reduction of interest rates.
Right, so the debt vehicle as opposed to the cap rate vehicle.
Yeah, the debt side of the equation is what's going to move the needle. I just don't see cap rates expanding more than where they are. And also, just to take a big step back, according to data and research and stuff, cap rates are, generally speaking, 70% correlated to interest rates. That's a very strong correlation, but it's not 100%. It's 70. And that other 30 is represented or is the reflection of capital flows. If investors really want to buy multi, no matter what does that mean? That means their equity is going to be willing to accept a lower return, which means that they're not going to demand the same return if interest rates go up, right? They're going to be okay accepting a lower return as interest rates go up because they just want multi so badly, right? And that's the difference maker, is if money is flowing aggressively, it's going to compress everything. It's going to compress cap rates, not necessarily irrespective of what interest rates are doing, but it's just not going to be a one-to-one move. But just keep in mind that it's roughly a 70% correlation. So we've seen interest rates rise a bunch, and that's been the predominant reason why cap rates have moved higher. The other thing to consider here is how psychology impacts cap rates. If we, for example, do have a recession and it really weighs negatively, not just on NOI, but on investor sentiment, if people look at property and go, oh my gosh, rents are going down, nobody's ever going to want to rent an apartment again, that's going to make cap rates go up. But I just don't see sentiment getting more negative than where it is and has been for the last while.
And I guess the only way it would get worse potentially is if maybe debt just kind of stayed stagnant actually and rates did not get cut, because in the event that would happen, what's coming in the next 2 years? Bridge loan maturities. You can only extend so long. So if rates don't get cut as much as people would like them to get cut and they're having to make massive capital calls, well, two things could happen. And sentiment could be bad, right? So that's one angle on it. But the second angle is, well, instead of buying new deals and allocating money there, you're replenishing a zombie deal, a deal that needs to get capital called, where there's just less liquidity in the market, and the harder to raise will naturally, make prices not increase, right? So that will be the other effect if that occurs. So those would be the scenarios in which, if it does get bad, but 30-year mortgage rates spoke with a couple people about this because they call me questions. They say, oh, what's going on in the single family market, as I typically do get questions here and there. And I'm like, yeah, well, mortgage rates just went up, but Bitcoin today, I think as of today or last night, was 55 grand. So the market's still really hot, and I think the Dow is at the all-time high. So it's very difficult to make sense of all of this, frankly. And I guess one way to look at it potentially, and this is obviously drifting away from the conversation, this is a macroeconomic topic, but printing this much money, that money has to stick somewhere, so it's just going to stay in the market potentially, and it's going to push kind of pricing up and inflate that. Nevertheless, wages aren't really going up that much, so we're just in a very weird inflection point. We are not market timers. We've said this over and over again. We're just looking to buy the best deals possible and not get too drunk one way or another on interest rates. Never get too hot, never get too low. And right now, when people are feeling this way is when we want to double down and get very aggressive and have call to actions to people here to make sure that you come into our deals and that you're raising wealth for us and you're coming in and investing with us, and we do a good job right now. Operations could get tough, but deals and sentiment could get worse if rents start softening slightly, if operations are tough, if these B and C class properties have more crime. So people see stuff like that and they get emotional as opposed to really looking at the numbers. So it's our job and our obligation and duty to buy the right properties, to educate people, and then finally to attract those people who may feel slightly gun shy or skittish to come into our deals where we're not really experiencing a lot of the problems that a lot of operators have due to, of course, the title of your book or debt and equity structure being, so solid, right? Having the fixed rate debt deals has really been a godsend, and, that's our profile moving forward. And there just really is, though, I think the overall arching thought, the amount of abundance out there, the amount of equity out there is crazy. So I am really excited about that. And we typically, I think, lean to more sophisticated folk. And the sophisticated folks that we're working with are really great. And, what we like to do, and we've been talking about this, we've been drilling this into our own brains, but, really offering our investors the deals first, offering, who've been investing with us, offering our in-house people that are there, first cracks, who, of course, are, in our deals, are receiving their nice distributions on a monthly basis where, they're not as, if obviously they invest in with other people, it's different, but they're, hopefully excited to see our offerings because they know they're going to get distributions, they're going to get some nice, hopefully, depreciation and can fulfill their annual contributions.
I think it's really telling what one of our partners said to us last week about the current environment. And this is a very experienced real estate investor, banker, and he said that right now feels like 2010. That's a crazy statement that was very validating to hear for me, because I can think these things, I can read about history, I can theorize, but at the end of the day, I was not there in the market in 2010. So I don't know what it really feels like to be in the trenches and to feel how it feels to go against the grain and invest when people are pulling back. Obviously, with the benefit of hindsight, we can look back at 2010 and go, oh wow, that was a fantastic time to invest. And everyone listening to this would be jealous of those that had the opportunity and the courage to invest at that time. And I think that's what we're going to see similarly, let me finish this thought, similarly in today's environment. The trouble about today's environment, just as it was in 2010, is it's very uncomfortable to be the winning bidder, especially when everyone is naysaying, right? In 2021, when everyone was fighting to outbid each other,
couldn't give your money quick enough.
Right, you couldn't overpay fast enough and just be so excited. Oh, I won the deal. It's so exciting.
JV groups are like, I really have to do this to do what for this deal? I have to do this term. I have to bend over backwards for this. That was the really common thought I've had for all the big institutional groups I was meeting with back in January. That was a redundant theme.
Yeah. So that's like Howard Marks says, in times like these, you need capital and courage.
Right. So with that said, I'd be curious to know if it really feels like 2010, because 2010 would infer, hey, the force is burned and it's about to reset. I think we're going to see more pain and more discomfort coming up here. I feel like we're more in 2009 then with that analogy, or 2008, or maybe we're turning the corner in 2009, but they're still bottoming out, some discomfort, some things that need to get worked out before it's fully leveled. I think we're kind of in the midst of the fire right now. I think we're really, truly, everything's being burnt right now. It's probably closer to being fully burnt than halfway burnt. so to speak, if we're using a force analogy. But I don't feel as if we're at the 2010 turning point yet. And selfishly, maybe I don't want to, because I want us to acquire more deals in this distressed period and then kind of roll over from there. So that could be the case. Obviously, he's more savvy and experienced than myself, but I just feel like 2010 would be a little bit too early of a precursor.
I hear you, and I think I agree. I don't think the window of opportunity is going to be quite as long.
Yes. Okay. That's, I guess that's a slight caveat, right? Is that this potential looming recession is not going to be as awful as the GFC. Therefore, the window will be shorter. And as of course JC has said, he thinks the window is basically October to June is what it's going to be, and it's going to be open and closed for the best deals. Now, I do think there'll be a little bit longer of a tarmac than that, but same thoughts apply, same idea applies here. And I do think the second half of the year will have a very interesting point where rates are getting cut and are trending down, and cap rates, of course, stay high, and investors, a lot of people are scared because, of course, they've been bit.
That's going to be the really exciting time, is when that spread, because there was that spread a bit ago when rates were in the mid threes. That was actually an exciting time for sure. And now that rates are 4.2, 4.25, it's eroding that positive leverage, right? The hottest topic of 2023. So that's something
if you're not buying a positive leverage right now, unless you're buying a trophy core asset in New York, probably South Florida, or Los Angeles or whatever, gateway markets as you call it, I think you're making a royal mistake.
Yeah, I think it depends. I mean, if you have a path to positive leverage, if you're buying, like you said, a true trophy with growth and irreplaceable real estate. Also, a lot of people are, in fact, buying on negative leverage. It's not as uncommon as you'd think, because they're buying on the premise of basis. Yeah. And the argument is this. Okay, yes, I'm buying a negative leverage deal, which means they're buying a low cap rate.
Which means you have to raise probably more than 50% equity, depending upon the debt structure.
Sure. And the price per unit is really low, below replacement cost. And I'm not talking about an 80s deal that's below replacement cost. I'm talking about a 2020 vintage deal.
Oh, yeah, of course. Yeah. Well, and this goes back to handicapping.
So with that in mind, this is how people are rationalizing those purchases. They're buying a brand new deal below replacement cost. So they throw away the cap rate. They just go simply put, I'm buying something that a developer cannot replicate for the price I'm in for. What does that mean?
Like Meritage. Yeah.
That means I have a supply moat.
Right.
Right? No developer is going to choose to build around me because they can't build for my price. I'm always going to win.
Yeah.
Now, the other side of the argument is, well, what's that going to do? That's going to cause rents to rise. And if rents rise, that's going to attract developers, and developers are going to come into the market. So it's kind of like a win-win, where if rents don't rise, you're not going to have any supply, and you are going to probably see cap rate compression, and so you're going to win, but even though you purchased at a low cap rate. Or rents are going to rise because of no supply, and you're going to win there as well. So that's how people are justifying buying on negative leverage. I don't think it's always justified, but yeah, at the end of the day, it never feels good being the bold person making that bold move when it's quote unquote not a no-brainer time to invest. But yeah, the points are, you made some really good points earlier about the stock market hitting all-time highs. I mean, that's not a comfortable thing right now, considering the economy that we're in and the circumstances that we're in. I think this is a big head fake. I don't like it at all. I think that the market is pricing in to perfection Fed cutting rates and achieving a soft landing, and for the economy to stay strong and for companies to hit their earnings.
Well, NVIDIA crushed it.
That's NVIDIA, right? That's just one company experiencing an idiosyncratic boon from the AI revolution, right? I mean, not to take away from NVIDIA,
No,
right?
I know. I was just making kind of a silly comment.
Yeah. No, it's a crazy comment because of, obviously, its market cap.
I saw the market cap, by the way, in NVIDIA is just shy of the Canadian GDP, which is nuts.
I think they added like 4 Airbnbs to their value off the earnings bump.
Yeah.
Yeah, no, it's totally nuts. But yeah, that's obviously idiosyncratic. And also, tech had their nasty recession.
Already.
Seemingly. And they're coming out of it already. So there's already some sector momentum in tech.
What's going to be really interesting, though, and this is a little bit of a side topic and tangent, is just what labor forces looks like, what the venture capital world looks like moving forward. And a firm and a company started today. The premise, kind of how we run it, just the leanest shop as possible, utilizing incredible systems and tools like automation and AI. And, if a bunch of, venture capital money that was basically put out from 2020 to 2023 effectively just got evaporated because the landscape of the market totally changed. And having massive overhead right now as a business owner, as you know, or just generally in business, is probably not the best because, these GPs, is that what it's called? GPUs are going to get so sophisticated and solid for analysts and stuff, where that coupled with a human is probably going to be the output of, multiple people, which is obviously very lean.
Yeah, technology has been deflationary since the beginning of time. Before the wheel was invented, right, humans were spending so much labor to, move things.
Horses.
Right, move things around, right? Then all of a sudden the wheel's invented. Now you can put wheels and a thing on a horse, and now you can transport goods much more easily, right?
Yeah.
And that's deflationary because now it takes less manpower, it takes less wages and labor to accomplish the same output, right? So technology, since the beginning of time, has been deflationary. So here we have another inflection point of the AI revolution that's going to be just another step in technology's never-ending drive towards productivity, which is deflationary. And for all the people, wink, wink over there, the argument we were having in the living room about inflation is not our problem. We have so many things that are deflationary that are happening. This inflation is transitory. It came from the supply chain dislocations. You shut down the economy and now it opened back up. You printed all this money. Of course we have to have inflation, but guess what? That's running its course, and now we have substantially restrictive rates and we have secular deflation always pushing us in that direction. So deflation, like to your point, this is going to exacerbate that trend. You're going to now have, instead of a team of 100, you have a team of 10. That's really deflationary.
Correct. Well, a lot of great things to unpack there. Another thing that we have been talking about for a while, and this is a structural difference, is crystallization. So specifically in the syndication world, can you explain what that means? We're in Sedona here, so don't get your thoughts twisted about crystals and things of that nature and whatnot, as this is one of the crystal and actually probably has more vortexes than any other place. So trying to make it a little topical for y'all. But can you explain what crystallization is, promote crystallization, who does it, why wouldn't one do it, and kind of the fundamentals associated and regarding it, please?
Yeah, what I'll say is it's quite rare for syndications, unfortunately, but that's something that perhaps we will change in the future. But a promote crystallization at its core and kind of what it's mainly used for are build-to-core strategies. A build-to-core strategy is where a developer develops a property, and then instead of being a merchant builder where they build, sell, a build-to-core strategy is when you build the property and then elect to hold it long-term. And that's why it's called build and then core, because when you buy a brand new asset and hold it, that's called a core investment, right? You have core, then you have core plus, then you have value add, opportunistic, and then finally the most risky of them is development. That's the risk curve going from core to development. The interesting thing about build to core is it matches the most risky type of business strategy to the least, right? Build, risky, core, least risky. The cool thing about that is you get the mixing and matching of risk profiles, but the funny thing about it is it's a total mismatch for the type of equity that generally wants to be involved, right? You have opportunistic equity that wants the opportunistic returns, you have core equity that just wants no risk and clip a coupon. So it's tricky to marry those two. Furthermore, us being in the private equity business, we know that in order to earn our promotes, we need to sell. The faster we sell, the higher the IRR. The higher the IRR, the more our
the quicker money can move, and we can get another acquisition fee and go through that process, so on and so forth. Not that we're trying to fee everyone to death, but
forget about the flipping and tumbling, just the time value of money and needing to actually sell to realize your promote, because I don't care how hard you hit a deal out of the park. If you don't sell as a sponsor, your promote just sits there on the balance sheet unrealized.
Right, if there is any.
And you don't get to make any money. So sponsors have that incentive to sell. So if equity does in fact have the desire to build which now they've developed a lot of value, and then hold forever, that's going to leave the sponsor out of luck on their promote. Therein comes the promote crystallization, which is the solution. The way it works is the developer and the equity partner up on the development. They build the deal, they stabilize it. Then at that point in time, they can get an appraisal, and they can then, let's say the value of the appraised deal is 100 million. They can then say, okay, well, this deal is worth 100 million, and if we were to sell it, they run it through a hypothetical sale scenario. So 100 million, you have closing costs, you have to pay off the debt, and then you run it through the waterfall, so you pay the preferred return to the equity, and then let's say the sponsor in the end has a $5 million promote on the deal or something like that. Instead of actually going through the sale, you just take the data from that hypothetical sale, which yielded the $5 million promote to the sponsor. You take that $5 million and you basically give the sponsor that $5 million by way of ownership in the deal. So if the sponsor, let's say, put in $1 million of equity into the deal, and then you crystallize the promote, now they have $6 million of equity in the deal. And I'm just using random numbers, so don't poke holes in my math here. Let's say the equity partner put in $10 million, or let's say $30 million of equity into the deal. They would actually reduce their ownership from 30 down to 25 to make room for the sponsor's promote crystallized equity now. And then the reason why they call it a crystallization is because now the promote structure is frozen, and moving forward, there's no pref, there's no promote. Everyone is now pari passu. So the sponsor now receives distributions pro rata with the LP, and everything is fair, equal, and it incentivizes both parties to just hold indefinitely. There's no tension between, oh, I want to sell, no, I don't want to sell, right? There's pure alignment.
So then the only fees associated with the deal at that point would be property management and asset management. Is that correct?
That's correct.
Awesome. And then is there a scenario in that situation where some investors could get refinanced out of their position potentially and bought out, and we could kind of buy in those shares, or other investors could reinvest, or maybe an outside capital partner is like, wait, I just want a stable deal. I don't really care about hitting this massive pop. That's not really what I'm interested in. I just want maybe a coupon of whatever cash on cash and get some depreciation or something like that. Is that something that could happen theoretically if there was a refinance or a capital event like that?
That's the other way to solve this issue. So instead of doing a crystallization, because not all equity partners want to crystallize.
Yeah, a lot of people, maybe some people want to just, hey, I put $100,000 in, it was a 2x equity multiple over a 4-year hold, give me my $200,000 and I'm good. And I'm out, and thank you very much, and I'm going to put this to XYZ deal.
If you're an opportunistic investor, your mandate is going to be to invest in opportunistic deals and trade out and go. So you partner with the developer, the development went well, you want to get paid out and move on and go risk your money on another development, right? So that's absolutely correct. And I'd say you probably see this more often than a crystallization. So what you would see is you'd see opportunistic equity come in to partner on the development side. And then upon stabilization, the developer, if they want to hold the asset long term, they will buy out the opportunistic equity with core equity. So they'd go to Mr. Opportunistic Investor over here, take the money, buy them out with Mr. Core Investor.
So they're really splicing it up there, huh?
Yeah, but you have to obviously have this negotiated, and
you got to be in the documents on the front end.
Buy-sell agreements.
Yeah.
And all that needs to be fair.
Fair appraisal, fair market value, what would someone pay for it, get some independent people in there. For sure. So let's talk about this, though, not from a builder perspective, because that's not what we do. So let's just talk about it in the frame as how Lone Star, if we did in this future, which we don't plan to right now yet, but at some point we've talked about this. We'd rather become or be more like a certain firm that we always reference, be more like them. It's one of our kind of people we look up to and kind of strive to be like. Pretty sure they do some sort of crystallization, or they just hold their deals kind of indefinitely, right? So buying more core deals. So let's say we buy 2005, something we'd want to hold more long term. So probably something that was built between 1995 to 2015. We bought something in that bucket. We buy that, we do that. What would that fundamentally look like for our investors and our capital partners?
Well, you can still get value out of a promote crystallization on value add deals. Value add deals still have not as pronounced, but a similar curve of value creation, right? We all know that the earlier years of a deal are the riskier ones, and it's also where more of the value is created. You buy the deal, you take over, you clean up the asset, you invest into the interiors, you raise rents, and you do that over 2 years, and that's where you get the bulk of your appreciation, and then from there, it's just kind of, you're subject to the market, right? So similarly to a development, on a value add play like that, you could buy it, turn it around, crystallize the promote, and then hold long term. That's one way to go about it. It's something that I would like to do for sure because it incentivizes us to hold long term. It is painful as a sponsor to hold long term and just basically write off your promote for years down the road, right? That's difficult. So you do need to come up with different structures. And so,
well, it's different probably segments and phases in the life cycle of a sponsor, right? So at a certain point, we probably want to, when we're a little bit fatter and happier, probably want to do more long-term deals that are probably better quality real estate that may, we want to hold longer. We may be set up for 5-year debt terms or 10-year debt terms and hold it like that. Maybe it was a floating rate situation, something like that, where it's more accretive for a long-term play as opposed to flip in, out, 2-3-year holds, right?
Yeah, absolutely. I mean, we're already thinking about it that way now, so I don't think it's necessarily so long into the future. No. MG Properties, for example.
Yeah, that was a group I was alluding to, but if you want to give them the shout, feel free.
The way they solve for this is they actually charge a cash flow promote. So they don't follow the institutional waterfall, which is pref, money back, then the promote, right? They go pref. If they're hitting the pref, then they'll take a promote on cash flow. For them, that makes it more comfortable and appealing to hold long term because they can actually make a little bit of their promote on cash flow. Obviously not a substantial amount because it's very, very tough to generate cash flows in excess of 8 or 9%. That's just the reality of the market. So I don't really see how that's fixing their issue very much, but that's what they do at least. But I would say their average hold period is about 7 years.
Right. So another point and the beauty of the promote crystallization structure that I want to really kind of drive home is the biggest risk associated to the property is going to be likely the takeover and the acquisition of it, because of course the brokers want to give you information and they can't lie to you too much, right? Because you'll never do business with them again. So there has to be some sort of, give and take there. But of course, there's just an inherent risk level with getting into a new property. Really, once you pop up the hood, how many issues or not issues are there? I'm sure we've taken over deals where it's like, wait, I thought this would be way worse, and this has been very smooth. And similarly, I bet a lot of deals we're taking over right now, because we're probably buying more distressed situations, because the market's a little more distressed, the takeover process likely is going to be a little bit more burdensome. So there's so much upfront risk associated with taking a deal over right now that the value of promote crystallization is you keep your money there. If the deal is working for you, yeah, you're not going to flip your equity as quickly, but it's safer. You're going to get good cash on cash return, and you know what you're getting there if you stay in a deal more long term. There's not necessarily, obviously you want to flip and go through deals, but that's not always the correct answer in a lot of cases. Usually, and I would say most of the times it is, but there's just the other side of the coin that should be considered and factored into the equation.
It's just different exposures. Some people want more risk, some people want less risk. What's nice is you're able to essentially get different risk exposures from the same asset and without having to bear double the transaction costs and double the takeover risk and everything like that, right?
Yeah, well, and that's the thing. If you're an investor, you don't want to get feed to death, right? Buying and selling real estate has a lot of costs associated with it, and then also you have liquidity events you have to solve for now, right? A lot of investors, like our friend's family, who's in at the B&B, they don't want to have constant turnover, feed to death, find another opportunity, this that.
Reinvestment risk.
Exactly. If they're getting somewhere between 7 to 10% on a cash on cash return in year 5 or so, why would you want to opt out of that situation? You're really not going to get better than that, right? Or it's very challenging to consistently get better than that opportunity.
Right. You can go take more risk in hope of achieving a higher return.
But the key word is risk.
It's very possible, but of course, yes, risk is there.
And then I also want to talk about, because the types of equity that would be open-minded to doing a crystallization. So a lot of the joint venture equity groups, private equity institutions that we work with and speak with, they raise somewhere between, it could be a $200 million fund to a $2 billion fund and beyond, right? But typically speaking, they're somewhere between, call it $500 million to $1 billion. They have to deploy in a couple of years process. They've got certain areas they like to buy in. You got managing directors that kind of cover certain areas. But these funds need to kind of go through a whole process, and they're more, opportunistic, as you alluded to that phrase before. They're opportunistic. They want to come in. They want to bring their money into these deals, and they want to essentially go in, do the business plan, and then sell out so they return equity back to their investors. They have a mandate to sell, so they cannot even 1031 exchange the next opportunity, as opposed to if we truly syndicate the equity, there is an opportunity and alignment to make that make sense and for that to happen. So not every equity will allow you, and obviously this is why you alluded to, the documents have to be set up accordingly, but not every joint venture equity group is open-minded to that, or REITs or whatnot. They have a mandate to go through, do the business plan, and if they can return a nice IRR back to their investors, that's strong for them to go out and to re-raise their equity from the institutions and the pensions and the endowments that they get capital from.
Yeah, they're in the fund business, so they're in the business of putting money out, getting money back, closing up the fund, showing the track record, and the quicker they put out the money and close up the fund, they can raise the next one, and that's the fund business. One thing you mentioned is REITs. And REITs are actually different because REITs are, particularly publicly traded REITs, they have perpetual capital because they just issue shares and shares just trade, and so they have their money forever. They don't have to sell. And we were actually on the phone with that REIT a couple weeks ago now, and they were talking about how they've done buyouts and crystallizations and stuff with their partners. They've actually done, their preference is actually not necessarily to crystallize, but actually just to buy the sponsor out. They rely on the sponsor to get in the deal because they rely on the sponsor's acquisition expertise, takeover expertise, management expertise on the business plan. But once the deal's stabilized and they've got a great asset on their hands that's running itself, they opt to actually buy out the sponsor. Here you go, sponsor, take your promote, see you later. Now we're just going to manage the deal ourselves because it's turnkey.
Awesome. Well, happy we got to unpack this kind of concept and thought. We've kind of liked it for a while. It's something that we're open-minded to, and I think probably not in this maybe first half of this next decade, but maybe the second half of it when we're a little juicier on some of these deals, or maybe in a situation where the market's gotten really hot and gangbusters and we want to, hey, we're looking for more long-term deals here. We feel that over the whole cycle of this, we may not be exiting in a favorable market, so why don't we hedge that and do, a longer-term loan here while rates are maybe lower before they re-raise them, and then maybe we could sell the deal off with a loan assumption, crystallize it, something like that, but keep an open-minded process to make sure that we, keep equity moving and keep investors happy and cash flows flowing. So with that said, another thing we also are working on, this is a new topic now, but this is touch points and cadences on touch points. So just, when we go out, our goal, as I said this, I think on the last episode, but just moving forward, we are always, or our goal is to meet with every single person that we've invested with, every retail or LP investor, as well as fund manager, capital raiser. So we're really making a push there. So as far as cadences and touch points and whatnot, do you kind of want to go through some of the flows that we have associated, or I guess the thought process we have with our touch points that we kind of do, and kind of maybe some of the methodical thought process regarding it?
Well, considering you've been congratulated or given the accolade of best communication, 10 out of 10 communication, maybe you should cover it.
Yeah, well, I mean, essentially, on what front do we want to go with this? This is wide. I mean, we typically like to, reach out to people, not just on when we have a deal, right? Because who else doesn't that? What we're really looking to do is check in with people, make sure that we're reaching out not just on a deal level, but on a human level to make sure that, we're actually approachable. And, people don't invest on numbers. Obviously they do, but they also want to invest with people that care about them, that they like, and kind of creating more likeness with people, building more rapport, just makes everyone feel more comfortable. I remember when it was in August when we had no deal, I was like, hey, let's go through all of our equity. Let's see who's actually a fit. Let's see in this equity group and from our capital raising perspective, who is actually a good fit. Because as markets evolve and change, as fundamentals kind of change and whatnot, a lot of the groups that we have in there might change their thought process from, hey, I'm not doing any multifamily, I'm only doing, biolabs and whatever, or I'm only doing industrial, I'm only doing, self-storage now, so sorry, but multifamily is off the card. Great. Well, why are we wasting any time, sending them opportunities and spamming them, and doing that when, over time, if they're ever going to go back in our space, they'll reach out back to us. So what we did, and what I spearheaded was basically reaching out to every single equity partner that we had, call them, see if they're still, looking to invest. Where are they at? What are they seeing? What are they going through in their deals? And is there a fit for us to work together? Because, as you said on stage, I eventually get to the point where if I've reached out and we've talked enough, it's either do something out of where, get off the pot. Okay, are we going to do business together or are we not? Are we a good fit or are we not? Am I barking to the wind? Do you already have a Texas sponsor that you basically, unless you have a unicorn, you won't invest with us, where it's like we're just wasting because we could raise that probably from someone else or give it to one of our loyal investors, which we can appreciate that, or loyal, capital groups. So it's one of those things where, is there a fit here? Are we going to transact or are we not? So getting those touch points and really just being respectful of everyone's time is super crucial. But, the cadence, I think we try to hit everyone, on a personal level, probably every 2 months or so, or, personal or deal level. I know we obviously are everywhere on LinkedIn, on all social media platforms, but be curious to know kind of your thoughts as to how we can optimize this. And just shout out to everyone. If there is a system that other sponsors are doing well or other capital partners are doing well that you've experienced and you want to give us some feedback as to what we could do to implement and get 1% better, because at this point we're just trying to get incrementally better every single day, please email me. You know the email, but once more, Craig@lscre.com.
I think the overarching thought that is really guiding us right now is going a mile deep rather than a mile wide. It's been a great ride of the last few years, like I've talked about.
Casting a wide net.
Exactly. And being really excited about, oh, wow, we're selling all these books and we're getting all these emails and we have a big email list and everything. But guess what? Email list doesn't mean
dollar list.
Doesn't mean dollar list, right?
Yeah.
At the end of the day, you need to invest in relationships. And you're talking about, these are very serious relationships. People are trusting us with their reputation,
their money, their family's money, and their friends' money. That's basically their entire reputation is staked on how we conduct ourselves in that deal. Obviously, we can't control what happens to the market, but we can control making sure that we put the best projections out there and we, do everything we can in our power to successfully manage and direct the deal once we acquire it.
Yeah, we can control what's in our control, and we can also put in 100% effort to be the best communicators. And obviously, one of the things that we get shouted out for the most is transparency, right?
I actually think right now it's communication.
Well, it's one and the same.
Right.
And we have 100% control over that. No matter what happens in the market, we have 100% control over that. So we're going to continue on that path. But the important point is going deep, a mile deep, right? These are very serious relationships, important relationships, hopefully lifelong relationships. Let's invest heavily. Let's actually meet people in person, right? This is guiding our in-person efforts, and we are really investing heavily. We'll spend whatever the dollar amount is, and with not anything twice about it. Well, at least you and Kent will. We will spend $200,000. We'll spend over $200,000 this year on hosting events, taking investors out to dinner, right? Hosting smaller events, bigger events. Meetups, and so all
conferences.
Sorts of stuff. Yeah, there's a lot of things that we have already happening and things that we have in the works that I'm really excited about.
Yeah, and we've been really brainstorming that, which I'm super thrilled about because I get to put my kind of creative hat on. I feel so grateful to be at the firm where not only do I get to do the hard number stuff, the sell stuff, but I also have autonomy and kind of carte blanche to really go through and implement ideas where we can all kind of spearhead them together and execute it and create something very special. But I do think earlier on, casting a wide net's not a bad choice because you want to just get your name out there to as many people as possible. But when we're at where we're at right now, reaching out to people and trying to chase people around who may or may not bring you a dollar is a fool's errand. Why wouldn't we work with the Rainey Smiths in the world? Shout out to you. People like that, the Gibbs, people we just met with, everyone that was at dinner. You can see the LinkedIn profile or LinkedIn picture that I posted there with people who are at dinner. Why wouldn't we focus on those people? Triple down on people who will do whatever it is, will always be a reference point. Why would we not triple down on those people that will bring us referrals that we like to work with, that are better to work with, are better to be around, and that want to be with us and want to basically sell on our behalf and do the work for us, in one way or another, because they believe in us so much? Why would we not want to focus on those people who are already sold as opposed to trying to convince someone that doesn't want to be convinced they're sold? I have someone in my mind that we'll talk about this off air, that it's just like, why are we kind of bending over or putting this person on pedestal to get this person's approval when, if we just work with enough, people that like us, over time they will hear a name so many times, they will come to us and we will attract the right people that come in. So it's couplefold. It's really focusing on and taking care of and being first in class and going above and beyond and, increasing a level of excellence so much that everyone loves us. We want to do that. And then by doing that, and people speaking to us, we will attract exactly who we want and who will be a better fit. And when you attract people, they kind of come into your frame, which is obviously more beneficial. If someone's reaching out to you as opposed to us reaching out to them, there's just an inherent dynamic that's associated. You want to be the person that gets reached out to as opposed to the other way around, right? So of course I will do all the reaching out in the world, but in time we're going to kind of flip the paradigm and attract.
Yeah, attracting is critical, and I'll end on just adding to your point. When you're starting out, casting a wide net absolutely does make sense, because there's no way that when you're just starting out you can rely on word of mouth and referrals, right? It's not there.
There's no baseline.
Right.
Right.
Then as you get there, then it absolutely becomes, hopefully, if you're doing things right, a sign of a growing, thriving business is the number one source of business for you are referrals. That's the best way to go.
Correct. And repeat investors. If you don't have
Right.
referrals and repeat investors, you don't have a business. I think we will end on that because we got places to go, people to see, sights to see, food to eat, pickle to play. So with that, thank you so much for listening to episode 37 of the Lone Star Capital podcast. Not to be confused with the Capital Spotlight podcast, but the Lone Star Capital podcast. And then, I'm going to say this. If you find this information valuable, if you find what we're speaking on to be truly important and makes a difference in your life, and you know anyone who you think might benefit from listening to us, to hear what we have to say, to be a custodian of the capital, please reach out to us. But if you don't feel comfortable with having them, come into our system, why don't you share this podcast with them? Why don't you maybe send them a clip? Because I think we're going to start clipping stuff out. Why don't you really share this, like, subscribe, do all of that. We don't really even push that at all, but we probably should start to do that and maybe add a little, hey, click here, like, subscribe. It would really mean a lot to us. We don't care to have the biggest show, but we want to make sure that those who are listening, we want to have steady growth, of course, like anything, but we really just want to make sure that the folks out there who are in the market to be looking at opportunities, and these people, it would be a shame for them to not see what we have going on, because we believe with that much conviction that we really are first in class. So with that said, please share, please keep spreading the gospel if you like us, and we will catch you next episode on the Capital Spotlight podcast.
Nope.
The Lone Star Capital podcast. Peace.